Welcome to Good Money Moves, the show where we share financial tips and advice to help you feel financially empowered. I'm Jenna, AVP of Marketing here at First Alliance Credit Union, and joining me today is Nick Meeker, our real estate lending manager. And I've invited Nick here to talk about a very important topic that I feel like a lot of younger adults are probably kind of thinking about right now as they become ready to buy a home. And that is, do I keep renting? How long should I be renting? And when is it time to buy a home? When's that right time in my financial life to become a homeowner? So we're going to dig deep into that topic today. But before we jump in, Nick, why don't you share a little bit about yourself and your role here at the credit union?
So I joined First Alliance Credit Union March 10th of this year, and First Alliance is awesome. We as a lender, sometimes there's loans that fall through the cracks, but the nice part about First Alliance is we can lend out our own money as well. So if we try to take a loan to the secondary market with Fannie Mae or Freddie Mac, and if for any reason it doesn't work out, let's say the credit score drops or debt to income ratio increases, we can still get that loan done. So I feel like we don't have to ever worry about missing a closing or not being able to help a borrower that goes under contract on a house. And that's huge because that gives everybody confidence. It gives the realtor, the customer, the title office, gives us the confidence. And knowing that you can get everything done is a good feeling.
Awesome. Well, thank you so much for being here. So let's dive straight into the conversation. And that is, what is maybe the biggest myth when it comes to kind of the rent versus buy conversation that a potential homeowner, somebody who's just starting to think about, maybe I'm ready to move on from renting and I'm ready to be that homeowner. What are some common misconceptions people have when they think about that conversation that they should be considering?
So a lot of people think that they have to have more money saved for a down payment than what they actually need. A lot of people think, I got to have 20% down. That's a common myth. And there's down payment assistance programs where you only need to have $1,000 down, or there's just really low down payment loans where you only need to have 3% down. So you don't have to have a lot of money to buy a house. But I feel like you do need to take a step back and make sure that if you're renting currently, are you still able to put money away every month? Because when you buy a house, you're going to have a lot more unexpected things pop up. You got usually lawn maintenance, you have things that can break in the house. When you're renting, you just call the maintenance company up and hopefully the maintenance company comes out and fixes it quickly and you don't have to pay anything. Mm-hmm. But if something breaks in your house, you got to pay for that. So if you're the type of person that's living paycheck to paycheck and you can't put a single, dollar away into a savings account, I would say it's probably not in your best interest to be a homeowner, because there's just going to be unexpected things that are going to happen, and then you're going to be put in a situation where you're going to have to make tough decisions.
So that's great. And I love that you bring up the fact that you don't have to have that 20% down payment to be a homeowner, but it's good to have some level of savings to bring to the table when you're ready to buy a house. But not that 20%, especially with the cost of homes today, is an astonishing number for a lot of people to try to save that amount. And so I think just knowing that is a great kind of first step. So I do want to talk a little bit about renting has its benefits, right? It can feel a little expensive sometimes, but to your point, there's a lot that's covered under a lot of rental agreements. Can you talk a little bit more about kind of the benefits of being a renter?
Yeah, so renting, the benefit basically is you're locked into your lease with whatever that payment is. Let's say it's $1,500 a month, $2,000 a month, $2,500 a month. You can count on that being consistent and being the same every month. Same with your mortgage payment, but with renting, you don't have any of the unexpected things that could happen, like a refrigerator breaking down or an air conditioner breaking down. And those things, if that happens, that can be a couple $1,000s. So I think it's easier to stick to a budget with renting because you don't have those unexpected occurrences. Yeah. But the downside is your money's just being spent on rent and paying that landlord's mortgage down. You're not doing anything to build wealth or equity for yourself.
Yeah, so you kind of dipped into a little bit of the downsides of renting too, with the fact that you're not really building any assets for yourself as a renter, but the positive being that you maybe have a little bit more free time because you're not having to take care of all those maintenance things that come up as a homeowner. So let's kind of talk a little bit about kind of the pros and cons of being a homeowner a little bit more too.
Okay. Yeah, with a homeowner, as a homeowner, the house is yours. You can do what you want with it. You don't have to get approval from a landlord or from anybody else. So every time you make a payment, a portion of your payment, the principal is being applied to the mortgage balance. So you do pay a lot of interest on a 30-year loan up front, but at least some is going towards principal. And then the house is also usually going up in value. So then you're building equity from the house increasing in value and from you paying down the loan. So you're creating that spread that's called equity. And over time, like especially in the last 5 years, if you bought a house 5 years ago, your house has increased over $100,000 in value. So if you are a homeowner right now, you could sell that house and cash in $100,000. If you were renting, you missed out on $100,000 basically.
Right. And you maybe paid $100,000, it feels like in some cases, in rent. Which brings up kind of another kind of pro and con, and like trying to help people understand how to make the decision between, do I keep renting or do I move forward with trying to buy a home and become a homeowner. You know, there's a lot of talk about the cost of rent rising, but the cost of homes is also rising. So how do you kind of weigh those two things in that decision-making process? How do you figure out which is still right for you when both of those things are continuing to increase? When's the right time to move from one to the next stage?
Yeah, that's a really good question. And it's going to just be really budget dependent and kind of timeline dependent on each person, because you don't want to buy a house if you're going to try to move to a different state or consider switching jobs and being transferred within probably 3 years. I would say your minimum time frame is 3 years that you want to be in a house. If you know, or if there's any of those uncertainties, you'd be better off renting and just knowing that, okay, I don't have to worry about any maintenance. I don't have to worry about paying any fees when selling the house. Because if you were to sell a house within 3 years, you may not recoup any money. You might actually kind of go in the hole a little bit. So that's where it can get a little bit dicey.
Sure. So it sounds like the longevity of being in the home is a big factor that maybe a lot of people haven't thought of. Because I think to your point, if your plan is to maybe move somewhere for a job for a short time, you know, a lot of people have contract work, and so they're maybe only going to be here for, 2 years. Buying a home doesn't make as much sense. You mentioned that you could actually end up kind of going in the hole in home ownership. Can you explain a little bit more about how that would work in that scenario?
Yeah, so I'll just give like a hypothetical example. Let's say you were to buy a $300,000 house and you bought it, a month from now, and it goes up $5,000 in a year and a half. But then all of a sudden you have a position or a opportunity to take a higher paying job. So you take that and you have to now sell the house. When you sell, you're not guaranteed that you're even going to get that increase of the $5,000 that the house increased. Plus, if you hire a realtor, then you have realtor fees and things like that to pay for. Even if you sold for sale by owner, you still have fees that you have to pay for. So there's fees no matter what. So that's where it gets risky. But I think the biggest thing between renting and buying is, how do you enjoy spending your time? If you're the type of person that when you get off work, you want to be able to come home, drop everything, and just go out and start doing your activities, renting might be a better thing for you to do, because when you have a home, you're going to have to come home and potentially mow the lawn, shovel, do cleaning and stuff like that. So there's just depending on your lifestyle, that plays into should you rent or should you buy as well.
Yeah, and I like that you bring that up, because there is a lot of additional maintenance and just yard work and things like that when you're a homeowner versus when you're a renter. Although I suppose it could also depend on your rental agreement. I think if you're renting a home, in some cases you still have to mow the lawn or shovel those driveways. So
that's true.
The type of rental property maybe comes into play a little bit there as well.
Yes.
But if the goal is to not have to do those things, you'd probably not want to rent a home that's asking you to do those things. So
yeah.
What
and you can buy different house types to try to skirt around that. So if you don't want to have a standalone single family house with a yard that you have to mow and stuff like that, you could consider buying a townhouse where all that stuff is done for you, or you could buy a condo where all that stuff is done for you. A condo is essentially like living in an apartment complex. So if you really like living in an apartment complex, but you want to add the component of building wealth and paying down a loan that gives you equity and eventually hopefully wealth, then a condo would be something very similar to apartment living.
Yeah, that's a great point, that you don't have to necessarily buy just a regular single family home to be a homeowner, that there are other options. That's a great thing to point out. What would you say, or maybe since we're talking about the home ownership end of things, what are some of the more common expenses or things that first-time home buyers maybe aren't anticipating when they start seeking home ownership as an option?
Yeah, that's a good question because it comes up all the time. So a lot of people think, how am I going to come up with the down payment for the house? And that's the only thing that they're thinking about. There's always two parts to buying a house. There's, okay, what's the loan requirement? What does it require for a down payment? So if you're buying a $300,000 house and the loan says you have to have a 3% down payment, that's $9,000. A lot of people forget about the back end part, which is you have closing costs. You know, the title office has their fees for what they do. There's an appraisal fee. The lender has their own fee. The state of Minnesota has a fee. The state of Olmsted County has a fee. I mean, you take all of these third-party fees and add them up, and those can be just as much as the down payment on the house. Mm-hmm. So people forget that. I'd say that's the number one thing that people forget. And then also, people always call the realtor who has the sign in the yard when they're looking at buying houses, it seems like. And that's actually not a good strategy because that realtor is signed on with the seller of that house to try to sell that house for top dollar. So if you then contact them and say, hey, I want to buy this house, and that realtor is representing the seller, you're not going to receive any representation because now that turns into what's called dual agency, where they can't give you any like tidbits of information that are going to help you with your negotiations.
So you should, if you're looking to buy a house, what I'm hearing is you should get your own realtor to help represent you in that transaction so that you're not having competing needs between
100%.
a single realtor. Awesome.
Yeah.
That's great advice.
Yeah.
What about things like PMI, private mortgage insurance? When that's something that I know when I was going through the home buying process shocked me, and I was like, "You want me to pay what?"
Oh yeah.
And some of those types of costs, or even just like having, as a renter, you may not have insurance that you're paying the same way you do homeowners insurance. So there is rental insurance, but I think a lot of people don't take advantage of that, and so adding in homeowners insurance and how that impacts your home payment, because if you break down, especially if you're having your taxes and your insurance escrowed, that is actually a big chunk of that monthly mortgage payment that you aren't maybe realizing how much goes into that versus what you're actually paying on the loan.
Yeah. As far as like a real estate mortgage loan payment goes, the loan has its principal and interest payment, so it's called PI, principal and interest. But then you have also TI after that, which is taxes and insurance. So the whole thing together, PI, TI, principal, interest, taxes, insurance, that's your total payment. And then you'll have your PMI. If you don't put 20% down, you're always going to have PMI, or most of the time you're going to have PMI, private mortgage insurance. And that doesn't do anything for you. It's a protection for the lender. If you default on payments, it's like a pool of money that the lender can draw from to help make the payments on that loan and to help sell it at auction and things like that. But yeah, the part about mortgages versus renting is, with rent, you just have that one sticker price of rent, like $1,800 a month or whatever it is. With mortgages, your payment can start at, let's say, $1,500 with your taxes and insurance and everything. But then if Olmsted County says, hey, we're going to increase your property taxes 6% this year, and then your insurance company says, hey, we're going to increase your homeowner's policy 10% because of all the hail claims and tornadoes and hurricanes and everything around the country, now you have a higher mortgage payment than what you originally started with. And that's a common thing that you'll get questions on from people, is they'll say, why is my mortgage payment changing? I have a fixed interest rate. Well, your interest rate never changed, it was fixed. But those variables that are in your escrow account, the property taxes and the homeowner's insurance, those are what's changing, and that's making your payment then change.
Yeah, and I'm glad that you bring that up, because I think that is something that if you're considering becoming a homeowner, you really do need to take that into account. Is, can your budget, you shouldn't like max out your budget out the gate when it comes to homeownership. You need to have some buffer built in there. And, to your point, when I bought my home, 13 years ago now, maybe 14 years ago, my payment was not even $800 a month, including the escrow and the insurance and all that. And now I'm approaching $1,000 a month payment because of that very thing.
Yeah.
The taxes have gone up, the insurance has gone up that much in that time frame. So those are the things that you have to be prepared for as a homeowner. And I'm glad that you brought it up, because I don't think a lot of people realize that those are variable expenses to your mortgage payment.
It really hits hard on the people that are with fixed incomes. If you have grandparents with their only source of income is their Social Security and their pension, and then all of a sudden you start changing these inputs that make the prices increase, well, then that can put people in a situation where they can no longer afford their home, and they're not really likely to go back into the workforce because they've been retired for however long, but because of property taxes going up, homeowners insurance going up, now their payment has become unaffordable for them.
Yeah. So I do want to bring it back to kind of the renter's side for a minute and talk a little bit about, let's say you've run the numbers, the budget looks good, you're ready to move forward, but you're kind of worried that your credit score maybe isn't in the best place. And one of the newer things that I've heard about is that you can actually use your rental payments to help improve your credit score. There's apps and different services that you can buy that will basically put your rental payments toward your credit score in some way. Is that, like, do lenders actually take that information? Does it actually show up on credit reports? Can you talk a little bit about those types of services, and are they effective?
Yeah. So some people, when they rent from a landlord or a property management company, those management companies will already report to the credit bureau. And so you're already having your payments report, which it's a good thing if you make your payments on time and you're not late. It's a bad thing. It'll hurt your credit if you miss payments. So credit reporting is great if you know you're going to be able to make your payments on time for rent, but your rent's not reporting. You can contact Equifax and pay for the feature that has your rent included in there, and that'll boost your score, because if you're making on-time payments, that's just showing that you have a good ability to repay and that you make your payments in a timely manner. But if you start becoming 30 days, 60 days late, well, now your score is going to drop. So putting that reporting on your credit report could hurt you at that point then.
Yeah, I mean, that's a good point. That's true with any type of payment that you're making, honestly, though.
Yeah. So
I do want to talk a little bit then about, credit scores in general when it comes to buying a home. What's like kind of a good score to be at if you feel confident and ready to move forward in home ownership? What should you be looking at for a credit score to have the most options available to you?
To have the most options available, I would say you'd want to be 740 plus for a credit score. And that just because then you can do a conventional loan, plus you could do all of these other types of loans that allow for lower credit scores. Mm-hmm. If your credit score isn't 740, we can still lend to you at 640 credit scores. And then if we in-house loans, we'll just look at your scenario and we'll listen to your story, and we'll even go below 640. Mm-hmm. We don't really have a set limit. We just look at it from a case-by-case basis. Does this make sense? Is it going to work for this person?
Yeah. So I guess if somebody is sitting in the position to like rent versus buy, what should their budget really look like? A balanced budget look like for somebody who's ready to move from renting into home ownership?
I always like to put buffers on every single payment that I have out there. But let's say your rent payment is $1,800 a month. With a mortgage payment, you're going to probably be looking closer to $2,000 a month in the times that we're in right now. But you want to have buffers for those increases that we were talking about, like property taxes increase, increasing or homeowners insurance increasing. And then you also want to have buffers for things that can break within the house too. So there's not a set rule, but a lot of people throw out 6 months of emergency funds in a savings account, because all it takes is one event, and if you don't have an emergency savings account, you're already behind the 8 ball at that point. So if you can take, if you have a $2,000 a month mortgage payment and you can have $12,000 in a savings account, 6 months worth of savings, that'll create a situation where you're not stressed out if something happens to you. You have a little safety cushion that you can kind of draw from.
Mm-hmm. No, that's really good advice. Any other advice that you feel like somebody who's considering moving from a renter to a homeowner should really know before making that final decision, one way or the other?
Yeah, I would say look at your budget, get that really dialed in and figured out to see what you're comfortable for, because houses are more expensive now, and interest rates have came down, but they're never going to be as low as they were 4 or 5 years ago. So to get into a decent house nowadays, you're looking at a $2,000 payment, sometimes a $2,500 payment. And you want to make sure you can be able to afford that. So if you're paying rent that's comparable to that, then it's probably not a big deal. But if you're used to paying rent that's $1,500 a month, and now the kind of standard of house that you want is going to cost $2,200 a month, you have to make sure that extra $700 is something that you can come up with consistently, and that you're not having to dig into your wallet and use credit cards and things like that. Yeah. So yeah, definitely just dissecting your budget to a T and knowing that you can or cannot do something. And then when you go talk to a mortgage lender, know that number in your head, because mortgage lenders can always pre-approve you for more than what you should borrow. And so that's where it's a slippery slope, because sometimes if people don't have enough discipline to just stick to their budget, they can put themselves in a situation where they buy too much house, and then if something happens, that's where they can get into a sticky situation.
Yeah, I'm glad that you bring that little tidbit up, because back to 14 years ago when I was looking to buy a home, that exact thing happened to me, where I knew what I was comfortable with from a budget standpoint, but when I went to the lender, they were like, well, actually you could probably afford another $30,000, and I'm like, but I don't feel comfortable with that, so please don't pre-approve me for that, because I don't want to search for it. So you do have some control over that budget-wise, which is good.
Yeah, you can ask your lender to tell you what your maximum pre-approval amount is, but that doesn't mean you have to choose that. You can then have the lender dial it down to whatever payment you're comfortable with. But that's why you'll see, Facebook posts all the time about get pre-approved first before reaching out to a realtor, because you don't want to go out looking at houses and fall in love with a house that's a $450,000 house, and you have the assumption in your head that, the payment on this is only going to be $1,800 a month. On a $400,000 house, your payment's going to be almost $3,000 a month. So it's better to look at the numbers up front and know how those are before you go out and fall in love with a property. That way you don't even look at things that are in that price range that you should stay away from. Yeah.
This has all been amazing information, so thank you so much for being here, Nick.
Yeah,
I feel
no
like
problem.
we could just keep talking about this, because there's so much to dig into, but it is time for us to wrap up. So thank you so much for joining us. This has been Good Money Moves, and if you want to keep learning about home buying and budgeting and credit scores, check out our website, firstalliancecu.com. And until next time, stay financially empowered.